Hello, my name is Professor Vasudevan. Today we will talk about return, risk and the security market line. So I think when people look at finance, what we say is that there are only two things that matter, and the two things are the risk of an investment and the return of an investment. So in this chapter, what we do is we talk about how do we measure the risk of an investment, what are the different types of risks, how do we measure the return of an investment, and finally we will talk about the relationship between the risk of an investment and the return of an investment, and that is the security market line. Okay. So as far as this course is concerned, what are some of the things you want to make sure you can do? Those are, you want to make sure you can find the beta of a portfolio, the expected return for a single stock, and the expected return for a portfolio. So here we talk about finding the expected return, the concept of diversification, understanding systematic risk, understanding the security market line and the risk-return trade-off, and finally using the capital asset pricing model or the CAPM. So we will talk about expected returns, we will talk about announcements, surprises and expected return, we will talk about systematic risk and unsystematic risk, diversification and portfolio risk, systematic risk and beta, the security market line, and the security market line and the cost of capital. Okay. So the first is, what is the measure of return? So typically in finance, the measure of return is the expected return. And what is the expected return? The expected return is nothing but the average return. So when you buy a stock or when you invest in a portfolio of stocks, let's say you look at a 3-year or 5-year period, on average, how much are you making on your investment? That is the expected return. Now, in the example we have here, we are talking about probabilities and we are talking about how much we make in each case. So here, how do you find out the expected return? The expected return is nothing but the average return, and that is given by the chance of each event or the probability of each event multiplied by the expected return in that case. Okay. So here we have 3 cases and we have 2 stocks. So what we say is that the next year we could have a boom year, we could have an average year or a normal year, or we could have a bad year. And what are the chances? The chances of a booming year are 30%, the chances of things remaining normal are 50%, and the chance of a recession, it's going to be 20%. And the reason being that when you add up all the probabilities together, it has to add up to 1. So for the first investment, stock C, you can make 15% in a boom year, 10% in a normal year, and 2% in a bad year. For stock T, it's going to be 25, 20, and 1 respectively. So what is the expected return for stock C? That is the chance of making 15%, which is 0.3, plus the chance of making 10%, which is 0.5, plus the chance of a bad year where you make 2%. That gives you 9.99%. And for stock T, that is 17.7. Okay, so basically here we are multiplying the chance of each event by the return in that event. Okay. Now the next is finding the variance and the standard deviation. And as I told you initially, you don't have to worry about finding the variance or the standard deviation. So the assumption we make is that you already taken a course in statistics and you know how to find out the variance and the standard deviation. Okay. So here the variance is given by PI, the probability of each event, multiplied by the return in that case minus the expected return, the whole square. Okay. So we want to move on and talk about portfolios. So in finance, one of the assumptions we typically make is that investors hold portfolios. So what is a portfolio? We say that we have a portfolio when we have at least 2 investments. Okay. So here a portfolio is a collection of assets, and an asset's risk and return are important in how they affect the risk and return of the portfolio. So here the risk-return trade-off for a portfolio is measured by the portfolio expected return and standard deviation, just as with individual assets. So here the first thing we are trying to do is that suppose you have $15,000 to invest and you have purchased assets, securities in the following amounts. What are the portfolio weights? So overall, you have 15,000. Out of that, you are investing 2,000 in the first stock, which is DCLK, 3,000 in the second stock, which is KO, 4,000 in INTC, and the remaining money, 6,000 in KEI. So what is the weight of each investment? So the weight in each investment is the fraction of your money invested in that stock. So here, for the first stock, that's 2 by 15, 0.133. The second one is 0.2. The third one is 4,000 by 15, which is 0.267. And the last one is 6,000 by 15,000, which is 0.4. Okay. So what is the portfolio expected return? It's pretty straightforward. The expected return on the portfolio is the weighted average return. So basically here, what we do is the weight of each investment multiplied by the expected return. So the weight of each investment is the fraction invested in that stock. So the expected return is equal to the sum of the fraction invested in each stock multiplied by the expected return of that stock. Okay? So consider the portfolio weights computed previously. If individual stocks have the following expected returns, what is the expected return for the portfolio? So the weights are 0.133 in DCLK, 0.2 in KO, 0.167 in INTC, and 0.4 in KEI. So once we have that, we can find out the weighted average return. So 0.133 times 19.69 plus 0.2 times 5.25 plus 0.167 times 16.65 plus 0.4 times 18.24. So that gives you the 13.75. Now, how do you find out the portfolio variance? Like I told you, I'm not going to ask you how to find out the portfolio variance given the standard deviations and so on. Okay. So we want to talk about the expected versus the unexpected returns. So if you look at a company like Apple, so let's say we are approaching Christmas, and one of the things that the market is looking for is what are, on average, what are the sales, let's say, for the iPhones going to be, okay? And typically, how do they find this out? It depends upon analyst forecasts. So the company might have some announcements, and a lot of analysts also follow a stock like Apple, which basically means that we can look at what, on average, how many iPhones is Apple going to sell. And once we have that, after Christmas, when Apple makes the announcement that they sold, let's say, 1 million more than expected, that is going to be a pleasant surprise as far as the investor is concerned. So the expected component is perhaps what is forecasted, and the unexpected component is whether the sales of Apple actually beat the forecast or was it below forecast. Okay? And basically here, at any point in time, the unexpected return can be either positive or negative. So basically here, it can be a pleasant surprise or it could be bad news as far as the sales are concerned. And what we are saying is that over time, the average of the unexpected component is going to be 0. Okay. So again, when you look at stocks, announcements and news contain both an expected component and a surprise component. And it is a surprise component that affects the stock price and therefore its return. So what we are saying is that on average we have some expectations, and if the stock just meets those expectations, it's not a surprise. There is no news conveyed by the actual earnings announcement or any other announcement made by the company. On the other hand, whenever there are surprises, so that could be beating the expectations or perhaps underperforming the expectations. Okay? So that is typically what drives the stocks. Okay? Now in finance, one of the things we assume here is that markets are efficient. So what is meant by an efficient markets is that basically we say that the stock prices reflect all public information. So there we are talking about a semi-strong form efficiency. Okay? So basically what we say is that efficient markets involve random price changes because we cannot predict surprises. Okay? And when you look at a stock, so let's say we look at a stock like Apple or Walmart or any other stock, basically what we are saying is that there are two types of risk you face as an investor. So the first one is the risk factors that affect a large number of assets, and this is known as the systematic risk. the non-diversifiable risk, or the market risk. So all of these are the different names for the same type of risk, and that is, we are talking about the that affects the so what are some examples? Some examples are changes in GDP, inflation, interest rates, etc. Okay. On the other hand, what is unsystematic risk? Unsystematic risk is risk factors that affect a limited number of assets, also known as unique risk and asset-specific risk. So what are some examples? Labor strikes, part shortages, and so on. So when you look at a return of an investment, what we are saying here is that the total return is given by the expected return plus the unexpected return. So what is the unexpected return? That is typically the unsystematic part. Okay, that's what we are looking for when you look at the unexpected return. So that might have something that is systematic, meaning when the whole economy changes, that could be systematic risk. Okay, and the second is something that only affects the stock that we are talking about. Okay. So we want to talk about portfolio diversification. So portfolio diversification is the investment in several different asset classes or sectors. Diversification is not just holding a lot of assets. However, if you own 50 stocks that span different industries, then you are diversified. So basically, if you look at portfolio managers or most investors, they tend to hold diversified portfolios. So how can you hold a diversified portfolio? Basically, we want to invest across different industries, and we just don't want to focus on one industry. So here, what we have is that we just want to look at what is the effect of adding stocks to a portfolio. So suppose we have only one stock. On average, the standard deviation, which is a measure of risk, is going to be 49.24. Now, what we see is that what happens when we add one stock. So if we add one stock, we will find that the average standard deviation is going to change from 49.24 to 37.36. So that is a decline of almost 25%. Okay. Adding two more stocks brings it down to 29.69. Okay. And what we see is that as we keep adding more, the effect is not as pronounced. So the biggest change is when we change from 1 to 2 stocks, and when we have around 30 stocks, the standard deviation becomes pretty stable, around 20%. Okay. And what we see here is that the ratio of the portfolio standard deviation, so by adding 30 stocks, the risk we are taking is only 40% of the risk you take with one stock. So what is the moral of the story? Basically, what we are saying here is that as an investor, it is very important to have a diversified portfolio. Just having one stock or two stocks or even 10 stocks is very dangerous. That can actually make your portfolio very volatile. Okay? So that is the reason why usually you want to have a diversified portfolio. So you want to have at least 30 investments. Now, most of the time, people like you and me, we may not be able to afford to buy the 30 different stocks simply because we have limited resources. So in these cases, one of the investments you want to look for is invest in what is referred to as an ETF. And what is an ETF? If you go to yahoo.com, finance, or some other place, you can find the definition. That is an exchange traded fund. Now, what is the benefit of investing in an ETF? Basically, by just buying one stock, you tend to have a diversified portfolio because that single stock is tracking, in the case of the Dow Jones, a set of 30 stocks. In the case of NASDAQ, thousands of stocks. And in the case of the S&P 500, 500 different stocks. So that is the reason why, if you are investing either as part of your company's 401k or perhaps for individual reasons, you definitely want to take a look at ETFs. Okay? So here what we are saying is that diversification can substantially reduce the variability of returns without an equivalent reduction in expected returns. Okay? This reduction in risk arises because worse than expected returns from one asset are offset by better than expected returns from another. So that is the reason why you should be diversifying. And if you look at this graph in figure 13.1, it tells you what happens when you add stocks. So when you have around 30 stocks, you will have a pretty diversified portfolio. And the risk you are taking, that is the systematic risk, the non-diversifiable risk, or the market risk. Okay. So the diversifiable risk or the non-systematic risk is the risk that can be eliminated by combining assets into a portfolio. And if we hold only one asset or assets in the same industry, we are exposing ourselves to risk that we could diversify away. So when you look at the overall risk, that is given by the systematic risk plus the unsystematic risk, and the standard deviation of returns is a measure of the total risk. For well-diversified portfolios, unsystematic risk is very small. Okay. So what we are saying here is that when you look at the overall risk, that is given by the standard deviation of the returns or the variance of the portfolio. And that is equal to the systematic risk plus the unsystematic risk. And whenever we hold a well-diversified portfolio, the unsystematic risk almost becomes zero. Okay? So what is the systematic risk principle? There is a reward for bearing risk, and there is not a reward for bearing risk unnecessarily. So what we are saying is that if you have a portfolio which is not well diversified, you might be exposed to too much unsystematic risk. And at least in finance, what we are saying is that nobody is going to reward you for that. So all said and done, you should not be taking the unsystematic risk. Okay. So what are systematic risk of different stocks? For Coke, it's 0.45. For 3M, it's 0.9. eBay is 1.58, and Yahoo is 1.85. So what does it tell you? Basically, it tells you how these stocks move with reference to the market. So the beta of a portfolio, basically it tells you when the market moves by 1%, by how much does your stock move. Okay? And all said and done, the beta of the market is 1. Okay? So a beta 1 implies the asset has the same systematic risk as the overall market. A beta greater than 1 implies the asset has more systematic risk. A beta less than 1 implies the asset has less systematic risk. Okay? So total versus the systematic risk. For the security C, the standard deviation is 20%, the beta is 1.25. For security K, it's 30%, and the beta is 0.95. So which security has more total risk? The total risk is given by the standard deviation, and that is for K. Which security has more systematic risk? That is given by the beta, and security C has more systematic risk. And which security should have the higher expected return? What we are saying is that the only risk that matters is the market risk, which is for security C, and that should have the higher expected return. Okay. Now we want to talk about how you can find out the beta of a portfolio. So the principle is the same. The beta of a portfolio is the weighted average beta. And what are the weights? The weights are the fractions invested in each stock. So here the beta of the portfolio is the fraction invested in DCLK times the beta of that plus the fraction invested in KO, which is 0.2, times the beta of that, which is 0.195, plus the fraction invested in INTC times the beta plus the fraction invested in KEI times the beta. So the beta of the portfolio is the weighted average that gives you the 1.731. Okay? And what is the beta and the market risk premium? So what we are saying is that the higher the beta, the greater the risk premium. So what is the market risk premium? The market risk premium is the difference between the return on the market and the risk-free rate. So what we are saying is that how much more do we get by taking the additional risk? And here we are comparing the return on the portfolio with the risk-free rate. So portfolio expected returns and betas. So basically here this is referred to as the security market line. And what is the security market line? We have the beta of the portfolio versus the expected return. And the point where it hits the x-axis, y-axis, that is the case where the beta is 0, and in this case you should be getting the risk-free rate. And what is the reward to risk ratio? That is the slope of the line which is given by the return on the stock minus the risk-free rate divided by the beta. Okay. So the security market line is a representation of the market, and basically here what it tells you is that the slope of the security market line is the reward to risk ratio, that is the return on the market minus the risk-free rate divided by the beta of the market. And here the final thing we want to talk about here is the capital asset pricing model. And what does it tell you? It tells you that the return on a stock is given by the risk-free rate plus the beta of the stock times the expected return on the market minus the risk-free rate. So here the return on the risk-free stock is given by the risk-free rate plus the beta of the stock times what we see in brackets is the market risk premium. Okay? So that is the expected return on the market minus the risk-free rate. So reward for bearing systematic risk measured by the market risk premium, and the amount of systematic risk is measured by the beta. So let's look at the old example. For DCLK, the beta is 2.685, and if the risk-free rate is 2.13 and the market risk premium is 8.6, what would be the expected return? So we should be making 25.22. For INTC, we should be making 20.71, and for KEI, which has a beta of 2.434, again we should get the risk-free rate plus the beta times the market risk premium. That should be 23.06. Okay, so this gives you the security market line again, and the beta of the market is equal to 1. Okay, so this basically concludes this chapter. So what are the things you want to look at? The main things we talked about are, we talked about what is the different types of risk. We talked about systematic risk and unsystematic risk. So systematic risk is given by the beta, and basically that assumes that we cannot eliminate that risk, while the unsystematic risk, typically that is given by a measure of the standard deviation, not the total risk, but it is put with residual risk, and that can be diversified away. And basically what we said was, to eliminate the unsystematic risk, we should have at least 30 stocks, and we want to make sure that we pick those stocks across different industries. We talked about how we can find the return of a portfolio. The return of a portfolio is given by the weighted average return. And what is the weight? The weights are the fractions invested in each stock or in each asset. We talked about finding the weighted average portfolio beta. Again, that is the weighted average beta of the portfolio is given by the fraction invested in each stock times the beta of that stock. And finally, we talked about the CAPM, and the CAPM tells you the relationship between risk and return. So that is where the risk is given by the beta of the stock or the beta of the portfolio. And how do we find out the CAPM? The CAPM tells you that the return of a stock or the return of a portfolio is given by the risk-free rate plus the beta of the stock multiplied by the market risk premium.